First, I'll talk about the Fed, and then I'll talk about the RBA minutes. Earlier in the week, we published a piece called "The Problem of the Fed," and in that we talked about the presentation of Eric Rosengren at Quincy, Massachusetts. And in that presentation, he talked about the difference between what the Fed, well, effectively he talked about the difference between what the Fed's understanding of the employment data is and what the market is. And in the first chart of that piece, which is chart 5 of his presentation, you see the most recent monthly employment numbers, which are averaging a bit over 200,000 jobs. But you also see as the shaded line the level which the Fed thinks is sustainable employment growth if full employment is to be maintained and this level of unemployment is to be maintained for an extended period. And the Fed thinks that sustainable employment growth is between 80 and 100,000 people, and that's less than jobs per month, and that's less than half what the average of the last 3 months has been. So what you've got is this radical disconnect between what the market thinks is the right employment growth and what the Fed thinks is the right employment growth. Now, the market thinks there's only a 22% chance of a rate hike this week, but we run a model which is similar to of the neutral rate of the Fed funds rate, which is similar to but not identical to the internal model that's run by the Federal Reserve. Stan Fisher, who's the deputy chair of the Fed, has said that these models are run updated for the Open Market Committee of the Federal Reserve every time it meets, which is every 6 weeks. I know one of these models is run by the San Francisco Fed, another is run by the Boston Fed, and probably another one by the St. Louis Fed. Now, our model says that the current neutral rate for the Fed funds rate is touch over 100 basis points, which is 60 basis points higher than the Fed funds rate, or the effective Fed funds rate now is, which means that really to stabilise inflation, you need rates about 2.5 rate hikes higher than they currently are. And that gives us about a 76% chance of a rate hike this week, which is, like I say, about 3 times that of the market, in exactly the same way as the perception of what the Fed thinks is sustainable employment, what the market thinks are a number of magnitudes apart. So as my concluding line, that the chance that the Fed is likely to tighten is more likely than not is as sound a statistical conclusion as I can arrive at. Yesterday I did an interview with Sky News just lunchtime, early lunchtime, 12:15, on the subject of the RBA minutes, which had come out at 11:30. And this is a significant meeting of the RBA, and it's shown in the minutes, and this is the meeting which Glenn Stevens is yielding control of the RBA after many years at the helm to Phil Lowe. So there's a kind of a mix of styles in the minutes. Partly you can see the influence of Glenn Stevens, partly you can see the influence of Phil Lowe. And the net result of this is that they come out reading as if they're operating for balance. I mean, nobody is actually overwhelming them with a view. But what the data says is that they think the economy is growing at about trend, which is consistent with unemployment being stable. They see that the fall in the terms of trade has come to an end, and has moved up slightly in the most recent quarter. But very, very interesting for me, what they say is that the downward pressure of that decline of the terms of trade will continue to have downward pressure on prices in the Australian economy for some quarters to come. They note that things which were of concern in the economy, such as the housing sector, are no longer of concern. They note that even though the auction clearance rate of established houses in Sydney has gone up, the total number of auction sales has gone down over the last year. And they say that nationally, the total number of auction sales of established houses has declined. So what you see is that area of concern is softening. The impression I got that the meeting was thought that the economy is stable, but subject to incoming data. And the incoming data, the hint of where that incoming data might come from, is given by that earlier comment that there would be downward pressure on prices for some time. Now, one of the few things we actually subscribe to is in economics is a monthly survey of inflation by the Victoria Institute. And what that shows is that there's a couple of measures of core inflation in that, and the average of that measure for June was 1.5%. But a couple of months later, if we look at the average of those two measures, the average of the level of core inflation is 25 basis points lower, 125 basis points. So what we think is going to happen is that when the RBA meets in November, they will have the updated September quarter CPI. That will show a further fall in core inflation, and we think that the RBA will react to that further fall in core inflation with a further cut in the Australian cash rate.